Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room. Let's jump right into the market here. We have a lot of green in the screen. Gold is up 260, silver up 20 cents, copper up 10 cents. Very strong market. We have digital currencies that are running pretty strong, reverting the correction that we saw. Let's keep an eye on the market here for a little bit. Let's just allow for the market to trade for the first few minutes here. I want to concentrate on taking a look at the market um, from a technical point of view and see where we are here. But I want to see this first few minutes here how it trades based on some economic news that came out regarding unemployment claims. There is some encouraging data that came out. U.S. stock markets opened higher on Thursday after encouraging economic data showed labor market strength and less inflation at the factory gate than they had been feared. A mixed bag of earnings from the country's biggest bank was enough to allow broad advances in all three major indices, with the Dow Jones Industrial Average gaining 297 points. So here's what I'm referring to as the fundamentals uh, are skewed from one day to the next. So trading the fundamentals is very, very difficult. It has been very difficult since last March. Let's just keep an eye on this here. Silver up 23.5 cents. Gold is up $4.50. We are in a bullish price momentum within the bigger trend that essentially is defined by the 9-week moving average, which is 1785, and we've broken through that. So we're breaking through a lot of resistance in the gold market. And the main number to watch is the 1820, 1830. If we close above 1830, it is a breakout, a major breakout. Earlier, the Labor Department said that initial jobless claims fell to their lowest since the start of the pandemic, at only 293,000, the first time they have been under 300,000 since March 2020. We really don't know the full effect of employment, you might say, here as we start to get these numbers moving forward from here. And what I want to see here, which is not showing promising numbers, is the amount of people that are not um, basically um, looking for employment. In fact, they are just walking out from uh, the hospitality area, the hospitality um, category, um, the hotel industry uh, seems to be experiencing a great deal of labor shortage. People are changing minds about their job. They realize they can work from home. Some are looking for other alternatives. I think the pandemic has awakened a lot of people in terms of exploring other possibilities that they probably did not think about before, such as working from home. And so, what we're seeing obviously is this stimulus that has come into the market, which is excessive at this point, is allowing for people to make choices ordinarily wouldn't be able to make, that ordinarily they wouldn't be able to make. Um, the market is flooded with cash. Interest rates still are going to remain low. And this is what I believe personally I'm looking at as a trader, which is the surprise that I think we are going to see with regards to interest rates as we move towards the last quarter of this year is that the Feds cannot raise interest rates. The economy, I believe, is going into some kind of a slowdown by the end of the third quarter. Um, it remains to be seen how this stagflation resolves itself with regards to the availability of supplies, especially coming into the holiday period. So there are a lot of uh, potential black swans that are flying around fundamentally that I believe have not yet been clarified. The debt ceiling, inflation, interest rates. Are the Feds going to taper or not taper? Very, very um, mixed bag of fundamentals. So let's come back to the market here and focus basically on the technical side of the market, which uh, is basically what the market seems to be adhering to, is the um, variable changing price momentum indicator, um, identifying basically the trading opportunities within a daily time frame, a weekly time frame, or a monthly time frame. We break the market down into trends. We use cycles to identify the extremities of the supply and demand. And the algorithm is a combination of a WD Gann, Fibonacci, um, vortex mathematics, moving averages, and directional movement, all within this simple structure that you see, which essentially just shows the pivot points, which is one of the components of the algorithm. In what I'm doing here basically during this live streaming is I'm showing you how I am executing this information. So far, for today, if we take a look at the prices for today, the average price for gold, if we take a look at gold, is 1783. And the market trading above the average price of 1783 is a bullish price momentum. The weekly average, or the weekly 9-week moving average, is 1785. So the market has identified a bullish price momentum. So holding longs is appropriate with a target of 1808 for the day. 1808 to 1822.23 are the targets for today. And you can see on the chart here that the price is trading above the mean, and the targets are the red lines that you see above. For silver, the average price is 22.96. The market is trading at 23.40. So as you can see here in this chart on the right, the market came down to the average price and reverted from here, activating a bullish price momentum from 22.96.97. The first target is 23.43, which is almost there, and 23.76 is the second target. So we are going for a ride, so to speak, on the long side of the market. We've been recommending to hold long-term core positions and to trade the short end of the market counter trend, which is what we've been doing. And when we get yesterday, when we traded, when we took the short trigger, we got stopped out, which was essentially verification that the market is ready to turn around. And then by getting out of the position, and regardless of whether we take a loss or profit, we are always covered by the long end of the market. So if we take a loss by shorting the market, it is made up basically by the long position that we are carrying open. It's simply a short-term hedge. This is what I refer to sometimes when we, let's say, get to the daily signals, um, as in fact we are now in gold, accomplishing what appears to be the 1800 target. The weekly sell-to level is 1799, and this is where we are. And so, if you came in long, depending upon your profile, how many positions you have, um, in the futures contract, for example, um, you can manage the profits here accordingly, because this is telling you if we close below 1799 is going to activate a short trigger. So we got to pay attention to the signals as the VCPMI gives us the extreme levels of supply and demand, or in other words, speculation. Now, it doesn't have to be that the market has to come down from this level, but it is a mathematical probability that is identifying from this level a 95% probability that we could experience supply appear. This area is distribution of supply. And on the daily, it's telling you that the sell one target where you could potentially identify supply or resistance is 1808. Excuse me. If the market trades above the weekly 1799, this level will become support for the next target, which is 1808. So we allow for the market to do what it's going to do. Market will do what it wants to do always, but the VCPMI gives us a frame. It gives us a structure, a very specific structure that we use in combination with more conventional technical analysis used. But the algorithm trigger points are identified by the synergy, you might say, around these levels. The VCPMI gives you deeper intelligence in how to interpret the algorithm. And this is what it's written in C++ in easy language, is the methodology, the logic, the trigger points. And the robot executes these trigger points. Excuse me. Let's just keep watching the market here. It's a kind of a quiet day, but with a very strong bullish bias. You can see on silver as well, the price activated a short trigger at 6 a.m. And this is pretty much the pattern that we're in. The thing I'm beginning to see here, and I want to alert my traders in the Discord trading room, and also my viewers here, that what we're seeing here, for example, is yes, we have a lot of supply and that came into the market at this level, as I said earlier, identify supply. So expect this uh, supply to come in as you see it here. But the thing that you are seeing is that there is a great deal of buying interest, which is more than the supply offered. And it takes the market above the previous resistance level. And this is where we made a high of 23.54. So the selling supply that is entering into the market is being met by strong hands. As you can see here, another attack on the short side, a reversion back to test the levels of support. In this case, this number is the Fibonacci 38.2% retracement from the previous high that we saw. If we take a look at the daily chart, you're looking at the Fibonacci retracement, basically. Now, last month, September 28, we published the 360-day cycle that identified for us the bottom to be coming in on the 28th. As it turned out, the bottom was made on the 29th at 21.41. That's pretty close to the expected cycle low. So what you see here is the reversion unfolding. Now, the cycle low came in to a blue zone, which is the algorithm telling you to accumulate the supply at these levels. This is an accumulation of supply level. And what you saw here is the market reverted. Buyers came in, bought the supply down here, accumulated more than the selling. And what you saw was a reversion unfold, a buy trigger, a bullish trend momentum developing, and the extreme levels above this mean, if we use the weekly signals, are being completed. So the first target of the extreme above the mean is 28,000. I'm sorry, 2321. And the second level target is 2372. Now, clearly here you see the daily numbers sort of matching the weekly numbers. 76 is the daily, 72 is the weekly. This is pretty close to a harmonic alignment, which is what shows as the highest mathematical probability that at these levels we are looking at about a 90% probability that upon completion and the market confirming, we could see supply come into the market again, large supply. Now, what I suspect is that the supply that is coming into the market, or the selling pressure that is coming into the market, is being met by very strong buying hands. And if we take out 2372, we're looking at targets all the way up to 26. 2689, 27, potentially, where the market could go. So it has to clear this resistance level decisively. So this is what I'm doing here in terms of interpreting, reverse engineering the logic of the algorithm. And I focus primarily on gold and silver because they are a monetary unit. If you trade in the futures contract, this is one of the ways that you can take delivery. So basically, it's up to the kind of trader that you are to determine, what you want to do with the markets. Whether you just want to speculate, day trade swing, or position trade, or you want to use it to basically build a foundation for you to trade in the cash market, the physical market, which is a whole different market. What we're trading here are the paper markets, which are highly volatile, and they do provide a great opportunity to capture some of these fiat currencies that I recommend when and if you realize a profit to invest it long term, and put it into physical, take delivery of the physical. I think gold and silver are going to be in very much demand once the highly leveraged speculative mentality out there learns or becomes aware again that gold and silver have traditionally been considered money whenever the monetary fiat currency system is on the verge of changing. Collapsing means a change of the old system. And I think, that's pretty much where we headed. If you take a look at the fundamentals. So continue to hold your long positions here, as I said, identifying the target zones and managing those profits accordingly. So in the meantime, my friends, thank you for the opportunity to share this with you, and continue to have a great trading day, great trading week, and I will see you real soon. Take care.